Welcome, everyone, and thank you for joining us today for our Entrepreneurship and Strategy Insight series featuring Professor Olav Sorenson. So Olav Sorenson is currently the Joseph Jacobs Chair in Entrepreneurial Studies, Professor of Strategy, and Faculty Research Director of the Price Center for Entrepreneurship and Innovation at the Anderson Graduate School of Management at UCLA. Olav has several research streams. One of the themes for today is economic geography, particularly how entrepreneurship plays a role in how competitive regions are, but also ways that they can support entrepreneurs better than other regions. And so we are so excited to have Olav join us today to share his insights on the spatial ecology of entrepreneurship. So Olav, take it away.
Great. Thank you, Sandy, for the nice introduction. I'm happy to be here, joining everyone. What for me is early this morning, but I imagine for other people, depending on the time zone, is either afternoon or maybe even evening. So this is a stream of research that I've been active in for, probably close to 25 years. Before kind of delving into kind of the specifics, let me first, note that, I have several co-authors that have helped on individual papers here, but two very long-time co-authors that have been involved with many of papers that I'm going to discuss today. So one is Michael Dahl, who is at Aalborg in Denmark, and the other is Toby Stewart, who's currently at the Haas School at Berkeley. So I think to start this, it's useful to give a little bit of a background of what was my sort of route into thinking about economic geography. I think a lot of my interest really began in graduate school. I was at Stanford in the middle of the 1990s, and for those of you who may remember that time, the Netscape IPO was in 1995. The stock market was booming, and all of a sudden, entrepreneurship, which really hadn't been that big of a thing before that, I would say, was on the top of everyone's minds. A lot of, fellow graduate students that I knew went out and joined startups. That seemed like the thing to do. And it particularly seemed like the thing to do in Silicon Valley. And so part of what got me interested was, why is entrepreneurship, sort of suddenly so important, and, potentially what is different about Silicon Valley. So the first thing that I did was actually I designed a survey, and the idea was to go out and survey tech entrepreneurs and ask them essentially why it was that they decided to move to Silicon Valley to start their tech venture. We didn't just send the survey to those that were in Silicon Valley. We actually sent the survey to some tech entrepreneurs that were located around the country, but the largest proportion of them was in Silicon Valley in the sample that we were looking at. And a surprising thing happened. When the surveys came back, we started entering all of the data. We had a reasonable response rate. Everything was sort of looking pretty good, except that when we came to the question of, essentially, why did you, sort of locate in Silicon Valley, or where did you move to? The answer was basically that nobody moved. In fact, 96% of the respondents had simply started their business wherever they had been living and generally employed right before starting their business. So that really led me to start, kind of rethinking how I was thinking about entrepreneurship in general, clusters more broadly. And the next step was we decided to kind of go out and do some interviews. And so one that was, I think, particularly formative was an entrepreneur who happened to be located in, I believe it was Redwood City. And we sort of went to this coach house or garage in the back where he had his business, kind of strewn out on a series of tables and desks with all these like chiclet style hard, floppy disks that they had at the time. And we started asking him questions about, well, when you were thinking about starting your business, what places did you consider starting? And at first, he didn't even understand the question. In fact, his initial response was, well, the reason I started in the garage was because my wife didn't want to have a mess in the kitchen. And so, to him, it wasn't, was it, Redwood City or Texas or some other place in the country? It was really just, why the garage instead of some other part of the house? He hadn't even considered the larger, kind of more macro geographic question. And I think, in sort of a series of interviews and looking at some more survey data, we realized that that's actually the norm. Most entrepreneurs are not thinking about where to start their ventures. They're just starting them where they are. And so then the question shifts to not sort of becoming so much about a choice of region, but about why are entrepreneurs in some regions better situated to start certain types of companies than others. And so that's really the core of what I would say is the, maybe the theory or the idea here behind the social ecology of entrepreneurship, that, regions vary in a number of ways, and that networks in particular, social relationships are important then in creating this spatial or local ecology. So we could think about three different types of effects, and then I'll kind of show how that relates to a series of papers. So one is an anchoring effect, and that's really this, kind of this first issue that came up, right? The idea that people aren't even really considering other areas. I think part of the reason they're not considering other areas is because most of them are embedded in their own social relationships. They have family, they have friends in the area, maybe their kids are in school, maybe their spouses have their own jobs. And so moving to other regions is incredibly disruptive. They usually don't even consider it. The second is something that's kind of more general. You could think about it as a demonstration effect. One of the reasons I think that some regions we might think of as being, sort of culturally more entrepreneurial is that you're more likely to be an entrepreneur, to think about becoming an entrepreneur if you see others that you perceive as similar to yourself engaging in entrepreneurship. So regions that have high levels of entrepreneurship will tend to persist with high levels of entrepreneurship in large sense because of the sort of like almost like the aggregation of a peer effect. And the last one is, which is probably the most important or most central to some of the papers that I've been writing, is really thinking about the access to resources. So the other thing that social networks do is they help entrepreneurs to access know-how, to access potential talent, to access financial capital for their ventures. And so entrepreneurs who have these local connections are better able to start businesses. And when they start businesses, those businesses are going to be more successful. So those kind of ideas have been, I would say, central to four different kind of sets of papers. And I've kind of grouped them as I would sort of see them. So the place that I started was really thinking about how does that then influence industry dynamics, or you might think about the formation of industrial clusters. And so there's a series of papers around that. The next set of papers that I did, or two sets of papers, interestingly, were almost like backing up from that industry's dynamic and saying, well, let's test more directly the assumptions, right? One of the assumptions is this anchor effect, that friends and family are keeping people local. And so there's a handful of papers that I did with Michael Dahl around that anchor effect. Or the other assumption is really this resource mobilization effect, that having these local connections better enables entrepreneurs to access various types of resources. The first paper in that set was with Toby Stewart looking at access to venture capital, but then Michael Dahl and I have done a couple of additional papers looking at more the overall performance of entrepreneurs. And I'm currently engaged in some research that's continuing to push that into thinking about hiring, in particular, who are the early employees of entrepreneurial companies. And the last set of papers, which I'm interested in, is sort of what are the implications for regions. So we could think about not just, kind of what are the implications for industries, this kind of clustering, for entrepreneurs themselves, where might they perform best, but how does that also influence the development of regional economies? And so there's a couple of papers looking here at really how this might increase inequality, economic inequality within regions. So the first paper there is with Jesper Sorenson, and then more recently, I have a paper with a PhD student from Yale, Doris Kwan, that's forthcoming in entrepreneurship theory and practice. So what I want to do is just go through some representative papers from each of these and kind of point out what types of evidence that I've been looking at. And I'm happy to, again, answer any questions along the way. Please just, put them in chat or use the Q&A function. So as I mentioned, the very first set of papers that I did here was really around industry dynamics. And the idea here was that, one of the reasons that we might see clusters, the sort of normal explanation for clusters has been that, well, there's something particularly attractive about starting a business in those regions. And so entrepreneurs who might be interested, say, in entering the tech industry would move to Silicon Valley, or interested in, going, say, entering the film industry might move here to Los Angeles. The very first paper that I did on this was actually on a completely different type of industry, on the shoe industry. You shouldn't think here sneakers, you should think more like leather dress shoes. And, one of the nice things about this at the time was that we had a very long history of data. So this is a paper with Pino Audia, who's currently at Dartmouth. And he had collected this, what at the time was a very unusual data set that had information, not just on, all of the shoe manufacturers in the United States, but also where their individual plants were located over a more than 40-year history. And so these maps here are essentially showing what was the location of footwear plants in 1940, and then what was the location in 1980. And what you see is that, despite 40 years of time, there's relatively little difference in the location. Now, in the one sense, you might say, well, that's not very surprising because, maybe what's happening is these are the same plants that are just sort of persisting over time. And so if many of them, lasted 40 or more years, we would expect to see the same distribution. But over this period of time, there's actually an enormous amount of entry and exit. So between 1940 and 1980, if I remember correctly, there's about 5,000 plants that enter the industry and more than 5,000 exit. And it's not as though what's happening here is that you're just getting different companies entering and exiting the same physical facilities. They actually have different plant locations in many cases. And yet, what's happening is we're seeing the new plants arriving in exactly the locations of the old plants. The degree of concentration here is really pretty extreme. If you were to use sort of some of the traditional measures of agglomeration that are oftentimes used in economics, the footwear industry over this period is one of the 10 most concentrated industries in the United States. And in some ways, those stats are not even revealing the true level of concentration, because even within the footwear industry, there is specialization within areas. So, for example, one of the large clusters of footwear industry is right around Boston. And yet, even in Boston, you have some footwear on the North Shore, and you have some that's south of Boston. And those two smaller clusters of firms actually specialize in different types of shoes. So one does primarily women's shoes, and the other does men's shoes. And that's been, again, consistent over decades of time, which is quite interesting. So obviously the traditional explanation for this in the, I would say the economic geography literature is that, well, there must be something about the sort of spillover, information spillovers, that being located near your competitors somehow improves your productivity and actually allows you to be more competitive at plant. So this is something that we actually tested directly in this. And in fact, what we looked at across this entire period was what was the relative performance of those plants that were located in isolated areas, so places that weren't near many other plants relative to crowded areas. And the dependent variable here, the vertical axis, is what's the multiplier rate of exit. So, for example, here in 1949, what we found as an estimate is that the predicted level of exit for the plants in the most crowded regions, places like Boston, St. Louis, Milwaukee, Wisconsin, that have large clusters of shoe companies, had exit rates nearly 3 times those of plants that were located in the most isolated places. So it wasn't that there was, in some sense, a competitive advantage to being located in these clusters. In fact, if anything, there was a competitive disadvantage. But what was happening is that the entry of new entrepreneurs was happening at an even faster rate than these plants were failing. So the agglomerated regions would continue to persist over time. Let's see. So there's a question from Michael Meeks. Given the growing interest in startup ecosystems, how do you see your research streams respective to these ecosystem conversations? Where do you see research in these topics going in the future, and where should we be going? So I think that, I started this research before people were using really the ecosystem label, but I do see this as very closely related to the ecosystem literature that, in 2 ways. So one is, what these kind of industry dynamics are showing is that it's really the ecology of the local industry to some extent that matters for where there is a risk set of entrepreneurs who might be interested or able to enter an industry effectively. And some of the papers that I've done with Toby Stewart, one on biotech in particular, looks at how other types of related resources, you can think about where there's a supply of skilled labor, where there's venture capital and so forth, how those influence startup rates. I think what's different about sort of what I've been doing from what at least some of the ecosystem conversation is about is that I've been thinking about, at least in the way that I've been modeling these, I've been really almost thinking about these various components like capital and labor as being almost additive, right? So you kind of need to have the right set of ingredients, and if you have all the right set of ingredients in one place, then you should get higher founding rates in an industry. I think the idea in ecosystems is that there's more to it than that. It's not just additive. There's actually complementarity between various pieces. So it's not just about sort of what the ingredients are, if we're thinking about a recipe analogy, but also how you're combining, the order you're combining them, the amounts they're combined in. And I think that to some extent, that's the big open question in ecosystem research. Most of the sort of evidence for that has been qualitative interpretation of case studies. Moving forward is hard because if we think about each region as being its own ecosystem, we just don't have that many units. So there's a couple of possible paths for thinking of moving forward on this. One would be to think about pairs of resources. So think about, is there complementarity between, sources of labor and venture capital, for example? And you could sort of systematically study different pairs of resources as a way of kind of building up to a more comprehensive theory of ecosystems. The other way forward, which is one that I'm pursuing right now with Michael Dahl, which I think is interesting, is to think about what is the relevant scale at which ecosystems exist. And maybe the relevant scale is much smaller than we think. So we're doing some work using data from Denmark, where we're showing that if you measure many of these resources and these relationships at the level of neighborhoods rather than at the level of, say, a city or a metropolitan region, that you get much stronger effects. And that's interesting because when you start going to the level of neighborhoods, now even in a small country, you'll have thousands of neighborhoods rather than maybe a dozen cities. So I think both of those could be interesting ways forward. Let's see, Maka has the industry agglomeration patterns. Let's see, they often start tracking industries at time t. For industries in the early stages, how should we think about the emergence of an industry and its original location? That's a great question. One that I haven't really attempted to tackle that much in my research. There's one project that I had that I started that realistically I've aborted, but I sort of try to convince myself that's not true. Where one of the things that we try to think about, so the interesting thing, if you look at the history of the shoe industry, and shoes different because, shoes have existed for centuries, right? So it's not like the shoe industry could be new to the United States, even though it's not new to the world. And one of the things that you see in the United States is all of the main clusters in the United States were seeded from immigrants who had been active in the shoe industry in the countries that they came from prior to coming to the United States. And so I started a project on the motorcycle industry, gathering data on motorcycle manufacturers in every country in the world that actually had motorcycle manufacturers. And that story seems to hold true across a really large number of countries, where the first motorcycle manufacturers in many countries, places like Argentina, Brazil, were not kind of natives who had seen a motorcycle some other place and then decided to start producing there, but rather immigrants from a country who had already been involved in manufacturing in the country they were coming from. And then they basically brought that to the new place. With places, so that's, kind of one for an industry that's not new. For technologies that are new to the world, then I think there's oftentimes a question of, is that, we oftentimes are thinking about these technologies as being some sort of recombination in the innovation literature. And is there some other technology that, could have been built on? So if you're thinking of something about automobile industries in its early days, you could have been thinking about like the coach builders who really had experience in building the physical kind of part of the horseless carriage. You could think about those that had been involved in different types of engine production, whether it was steam, gas combustion, or electric, in other types of applications. The interesting thing is, I think that produces like a set of feasible locations, right? Places where there had been this kind of skill set available. And then I think it's a really interesting question of why it emerges in one place versus another. And at what point does it start, in some sense, consolidating on, one of those potential locations? I think that's a fantastic, somewhat open question for research. Yeah. So let me head back to the kind of industry studies. So as I mentioned, the other, I've done the same type of industry dynamics in other settings, one of which was biotechnology, a tech industry, which saw a very similar pattern where the early tech place, or kind of biotech centers, were really driven by which universities had early departments related to biotechnology, and then some of the first companies that were dedicated biotechnology companies. Though obviously it, sort of diffuses from those initial locations over time. And I have another paper that's in a book chapter that shows that the same type of patterns held in the computer industry. So that's, kind of one type of set of papers thinking about industry dynamics. Again, I think there's, as of the questions have shown, there's some interesting open questions, I think, still around industry dynamics. And I may come back to that if there's time. So the second kind of cluster of papers was really then trying to think about, can we, kind of show evidence for this, but essentially was an assumption that entrepreneurs are largely staying put, that we should really think about these ecologies as being largely local phenomenon. And so in a series of papers with Michael Dahl, what we did is we essentially looked at to what extent are people, particularly entrepreneurs, but also high-tech employees, tending to stay in the regions in which they're located. And what made this set of papers interesting is that we set them up as choice models, where we could actually come up with a counterfactual wage. So, or counterfactual earnings. So essentially what we did in this set of papers is we said, well, let's find somebody that's very similar to you, that has the, the maybe degree in the same area, works in the same industry, but is located in a different region. What does that person earn on average, or what are their expected earnings? And so then you can think about an individual, well, it's an entrepreneur or an engineer, their choice of where to locate as a function of what they're earning at their current location versus maybe a potential economic draw. The other thing is we were doing this in the Danish data, so we could look at other potential draws to regions. So we could look at, well, where is a person's family living? So we looked at parents, we looked at siblings. We could look at where are their friends. Now, we don't actually have survey data on who people's friends are, but what we looked at is where did the people from your high school class move to? So where, might people that you knew in school growing up live as different potential draws to regions. And then we could estimate that in a location choice model. And so this is the example of the importance of different factors to location choice for engineers. And so the most important thing is, most people are inert. They just stay wherever their current home is. Even if they move to a different address, they stay in the same commuting area. To the extent that there is a draw, the most important draw here was parents, then high school classmates, college classmates. We looked at past places people lived. Income, actually was relatively unimportant, or at least the differences in expected income relative to these other factors. It's about a third as important as parents. The other thing that's interesting that you can do with these types of models is you can take the coefficients from the location choice model and you can calibrate them on income. So we could sort of say how large would the difference in income between two places need to be in order to make somebody equally sort of indifferent between the two locations. So for example, doubling the location to parents is equivalent in the models to about $13,000 per year in income. Given that the average wage in the set is $70,000, it's a fairly substantial amount of income that would take to kind of offset that proximity effects. You could think about this in different ways. Some of this is obviously just personal preferences, wanting to be near friends and family. There may also be some aspects of this that are more functional, in the sense that, parents, what's oftentimes the case, this is in Denmark, a lot of the parents are involved in helping with childcare. And so there could be a very rational reason and sense for valuing proximity to parents. Let's see. Isn't the variable of current home highly influenced by the other variables? Yes, it is potentially influenced by the other variables. And so, to that extent, we're really looking at, kind of what variation is available, in some sense conditional on that. So there are a lot of cases where people are already living, kind of near their parents and siblings. And so you could think about those as being, highly collinear. But there's also quite a bit of mobility in Denmark. So the average Dane moves almost as much as the average American over their lifetimes. And that's really where we're getting the variation and that we're using to estimate off of this. We also did this, although I'm not going to present sort of separate results for this for entrepreneurs. One of the things that's really interesting about the entrepreneur set when we did it is that entrepreneurs tended to be even more sensitive to locations of friends and family than paid employees. So to the extent that they were, kind of locating their businesses in particular places, they were even more likely to locate them near family and friends. That was true even if we excluded cases where the parents or relatives might be involved in the same or a related industry. So kind of eliminating anything that might be, kind of a direct economic advantage to locating in these regions. We also did some modeling looking at, kind of what it was from an industry perspective that would attract entrepreneurs to particular regions. So to the extent that they did look at regions, they oftentimes would tend to move to places where there were more firms of a particular type, again, if they were moving. Despite the fact that, again, moving to a place where you have a lot of competitors increased your expected failure rate and reduced your expected long-run profits. So, the entrepreneurs to some extent, seem to almost be doing what you would expect in terms of the traditional economic geography literature, even though it's not clear that it's in their economic interest. So the next set of papers, which I'll go over, is one that's really been trying to get a little bit more directly at the resource access effect. And so are entrepreneurs benefiting from being in a region where they have social connections because they're better able to access resources? And the first paper that I did here, and the only one that I'm going to go into detail on the access to a particular resource, was looking at venture capital. So this is this paper with Toby Stewart, AJS 2001. And, one of the ways that, you could think about this is, we're looking only at companies that receive venture capital funding. So you could say, well, for those that receive venture capital funding, which in some sense is a baseline quality control, what is the probability of being funded by a specific venture capitalist based on your distance from that venture capitalist? And what we see overwhelmingly is that you have a much higher likelihood of being funded by a venture capitalist who is, essentially across the street from your startup versus one that's even 100 kilometers away. So like an hour drive reduces the probability by roughly 80% of being funded. And there's really, I think 2 reasons why we might expect that to be the case. One, we could think about sort of a pre-investment story. So, prior to investing in a startup, venture capitalists are relying on their social networks, both to identify potential startups to invest in, and perhaps even more importantly, to do due diligence on those startups, right? There's not a lot of information available about a startup that is at its earlier stages, might just have a business plan or even a pitch deck available. How can the venture capitalist assess whether this is a reasonable investment opportunity, whether the entrepreneurs are able to deliver on their plan, and they rely heavily on social networks to do that. In particular, what's important is, do they know someone who knows the entrepreneur, right? You can think about, do they have a trusted source of information besides the entrepreneur themselves? And because all of those relationships tend to be, spatially constrained, right? If you think about who is it that you know in your own life, most of the people that you know, are friends with, or colleagues, are located in the city that you've been living in. And academics are some of the most mobile people in the world. If you think about sort of a business person whose career has oftentimes been in a single place, their network is overwhelmingly in that location. So that means that most of the ventures that VCs are able to assess are going to be in the same regions or very close to their offices. And that's one type of explanation for this. Another type of explanation is post-investment. So, even after the investment has been made, venture capitalists are active investors. And so they are advising the company. They may help the company recruit executives. They are better able to do that. It's less costly to them if the company that they've invested in, their portfolio company, is located close to them. And so I think there's both a pre-investment and a post-investment reason why you would see this relationship. Now, the paper itself also, spends a lot of time looking at how this distance effect is moderated by a series of other variables as a way to try to really dig in what might be the explanation for this basic relationship. And the main thing that we show, excuse me, is that nearly all of this relationship is driven by the network. So, firms that do invest at a distance, in fact, invest with other syndicate partners who are located near the venture. So typically, if a venture capital is investing in something that's in the other, let's say the other coast or even in a different city, they're not going to be investing in it themselves. They will be investing in conjunction with a syndicate partner who is located very close to that company. So again, kind of suggesting that what's really underlying this distance effect is these social relationships. I'm currently working on a paper that's trying to kind of do something a little bit similar, although also addressing some other questions around hiring and looking at how there's differences in hiring depending on the location of the entrepreneur and the depth of their networks within a location. I'm not going to describe that, but I do think that's important to the next paper. So another paper that I would sort of think about as being in this stream has been really thinking about, well, what might be the aggregate effects of this? So we've thought about, the implications of this overall idea for industries. It's that we get this persistence of agglomeration effects, even if agglomeration is not economically beneficial. At the individual level, though, there's a little bit of a different type of prediction, which is that it will actually be advantageous for an entrepreneur to locate their business in a region where they have deeper connections. And so this paper here that I did with Michael Dahl in 2012 was looking at the performance of those who had lived in a region for many years relative to somebody that moved to a region to start their business. And this is showing the startup survival rate, so the probability of survival by venture age. But you can see that the locals had a serious advantage relative to newcomers, those that moved to a region in the survival of their startups. And in the paper, we show that this holds across a variety of different outcome variables. So if we look at sales growth, those that are embedded in the region have faster growing businesses. If we look at profitability, they have more profitable businesses, as well as survival rates. So on many different dimensions of performance, they seem to do better. Colleen asks, do you think part of the anchor effect is because entrepreneurs' business type choices are influenced by the location they live in? I pick the type of business that matches the local demand, or okay, so yeah, so this is, I think there's a little bit of both. I think the stronger aspect of it is that people are deciding that they don't want to move. They want to be, kind of near family and friends. But there is definitely an aspect of, staying in regions that are seen as sort of strong or have, maybe have an infrastructure for a particular industry. And this really, comes out if we think about, well, who's able to start a particular type of business, right? There's quite a few studies that show that those who have experience in industry tend to perform better if they become an entrepreneur in that same industry or in a related industry. Well, where do they get that? Well, probably by being an employee in an area where there's a cluster in that industry. And so, part of what's happening here is that the entrepreneurs who are, best situated to start a business in a particular type of industry are going to be disproportionately located in places that already have a concentration in that industry. But I do think that a very large part of, what we're identifying as the sort of anchor effect is really due to these kind of social constraints as well. Let's see, Sandy asks, it seems that during COVID, the investor entrepreneur distance has been shortened. What will it mean to be local when resources can be distributed? So I think that's a really interesting question. So I remember in April of 2000, talking to a couple of VCs, and I had two VCs sort of in independent conversations tell me that they had invested in their first entrepreneur ever without meeting the person in person. And, that was super interesting in the sense that, it seemed to be like a bit of a weakening in this, the advantages of proximity, because if you don't have to meet the person in person, particularly pre-investment, then why would you necessarily need to invest in somebody that's located within a short drive from your office? You can have a Zoom call with anyone across the world, and so you might think that it would dramatically weaken this location effect, and that that may be true. I think it will be interesting to see what happens, as we get, kind of post-COVID. Obviously the other thing that we've got going on right now is that, given what's happening in capital markets, in general, there's a decline in VC investing, less so in seed stage and A than in later stage investing. But capital is drying up a little. So, what will in some sense be the combination of those two forces? Is that going to lead to kind of people really searching for opportunities everywhere, or will people kind of bring back, and you could think about like retrench toward home? I don't know. I mean, I think that the, I'm not sure what's going to happen. I mean, I did do a little bit of the original paper that, Toby and I did was in 2001. Prior to COVID, I had actually started to do some analysis, kind of updating in some sense to see, how true those patterns held. And in fact, venture capital investing had become more local over, from 1999 to 2019. And one of the reasons that it became more local is because there's more VCs in different places. And so it's, for a venture that's, say, in a place like Minnesota, in 1999, there were almost no investors in Minnesota. But now, there's a whole set of VC firms there. And so they can get a local investment, at least in the early stages. So the trend had been actually for VC investments to become even more local. I think it's an interesting question of what will, COVID was obviously relaxing that, which trend will in some sense take over as people go back to meeting in person. Let's see, I feel like I missed a question here. Jing Dang, do you think the anchor effect may make entrepreneurs who start their career venture far away from home to move as well? So, I've always felt like if you think about the combination of what I'm finding, some of the opportunities in some sense for entrepreneurs is to be entrepreneurial with respect to location as well, right? So you could think, if I have a background in, the software industry and maybe connections to Silicon Valley because I work there, but, I'm from Wisconsin and, I have strong kind of social networks there from school and family. I could potentially move back to Wisconsin, still have, some of the important business connections and know-how from Silicon Valley, but be able to start something meaningful in a place with much lower cost of doing business. And I think that's an interesting opportunity. And maybe that'll actually be, there has been this kind of general trend, at least during COVID, it seems like, for people to be moving away from some of the kind of dense cities. And so maybe that's a type of form of entrepreneurship that we might see more of, people taking advantage of having in some sense a social connection one place, but a business connection another, and becoming a geographic entrepreneur, as it will. Again, I think that's a super interesting phenomenon, although very few people move to start their businesses, which is where kind of I started. Let's see. So moving along, there's one other thing that I'd like to kind of get to before I shift completely to questions, and that's this latest stream of research. So you can think about the first set of papers was really about what are the implications for industries. This kind of second set or the second and third set are really thinking about the individual level dynamics and what are the implications for entrepreneurs. The other thing that I've been increasingly interested in is thinking about, well, what are the implications for regions themselves, regional economies. And here, one of the kind of papers that I've been working on, quite interested in, is really inspired by something that's known as the Dutch disease. So in the 1960s, the Netherlands discovered petroleum in the North Sea, and that really changed the Dutch economy. So what happened is, as they started extracting the petroleum and converting into various types of products, the economy went from being one where exports were almost entirely based on manufacturing to one where they were mostly exporting these kind of raw materials or processed commodities. And there are really kind of a few stories about why that happened. So one, what had to do with currency appreciation, the fact that the Dutch guilder rose as they were exporting more and more oil, which made it harder for manufacturers because effectively their costs of operation, since they were manufacturing in the Netherlands but then exporting elsewhere, became more expensive relative to other countries that hadn't had the currency appreciation. Currency volatility was a more subtle effect that maybe amplified that, in the sense that if you're a manufacturer and you have imports coming in from other places, volatility makes it very hard for you to predict your cost structure and to justify capital investments. And so both of those sort of worked against manufacturing. There was also, during this period, a general shift in where people wanted to work. So people shifted, managers were up and coming, no longer were interested in the manufacturing firms in their career. They really wanted to enter petroleum industry where the rewards were higher. And likewise, and the kind of the net effect of this was that you had an increase in the exports of oil, you had a decrease in the exports of manufacturing. In fact, the decline in the manufacturing sector was so severe that net exports actually went down during this period. So how is this relevant to kind of what we're talking about here and thinking about maybe kind of tech clusters? Well, I think there's something very similar that can happen in the tech industry. And it's the Dutch disease has usually been thought of as being like a national level phenomenon. I think precisely because so much of the theory and discussion of it had to do with currency, current exchange rates. And obviously that's something that exists at a national or supranational level in terms of fiat currency. But really, if we think about what's driving this is changes in the cost structure. And I think that you can get the same type of effect at a regional level, but where the changes in the cost structure are driven because you have different types of factor markets that are unable to adjust very quickly. So what is that here? So we're basically saying that Silicon Valley syndrome is like a regional version of this that you might see with tech industry in particular. And I think one of the reasons why tech is a place where you'd see this is because it creates extreme value, at the level of, kind of the with a relatively small number of employees, right? So if you think about like the Google search algorithm, it doesn't take that many people to design or to implement the Google search algorithm, and yet then it's producing billions and billions and billions of dollars that get injected into the local economy. So what's the kind of the idea behind the Silicon Valley syndrome? Well, we're seeing local cost appreciation, primarily due to the bidding up of both salaries of skilled employees, but also due to demand for real estate, which is relatively inelastic. And that's bringing both talent and capital into the industries that let's say are backed by venture capital or tech industries, and pulling them out of other parts of the tradable sector. That could be manufacturing, but it could also be, think about tradable services, things like consulting, auditing. And so in the end, what we seem to see in Silicon Valley or in regions that are undergoing these kind of tech booms is that the tech sector ends up crowding out both the non-tech tradable sector. And interestingly, we find that it seems to increase inequality in the non-tradable sector. So the non-tradable sector are like local services, which we might think about things like restaurants, but local services also includes things like medical care, dentists. And so if we look at what's happening in response to tech booms, we're seeing increases in salaries among those who are already highly paid, dentists, doctors, financial planners, and no increase or maybe even declines in the earnings of those in things like fast food restaurants and other types of low-end services. And so overall, one of the implications is that kind of these clusters, and the particularly tech clusters, seem to be leading to increased inequality at a regional level. Let's see. So Michael, stepping back, what do you tell econ development efforts regarding how to increase startup activity? Yeah, so there's a, I basically told a story about how once you have sort of a cluster or a high level of entrepreneurship, there's a lot of reasons why that would persist. And one of the things that I think is an open question, and this also relates to kind of the new industries question, is, well, what gets these dynamics started? Or alternatively, almost as open, as interesting as kind of what ends them. I've been thinking about this less in terms of the kind of development in, say, lower income countries, and more even in terms of regions within relatively rich economies. But I think even there, it's an open question. I think one thing that that I've been thinking about, I've speculated a little bit about in a thought piece in the Journal of Economic Geography in 2017, and I've been starting to do some empirical research on, is what might account for these kind of shifting dynamics over time. And I think there's some inspiration here from a classic book. So Anneliek Saxenian wrote this book, Regional Advantage, back in the early 90s, and it's an excellent piece of work. And it's really comparing, Silicon Valley to Route 128, which is the area around Boston. And the interesting thing about it is that, Silicon Valley is portrayed as this, very entrepreneurial, dynamic region. And, Boston is like the epitome of the staid, economy that's going nowhere. And yet, within 10 years of her writing this book, Boston, or, more particularly Cambridge, had itself emerged as really almost a hotbed of entrepreneurial activity. And so, I think, kind of an interesting question here is to think about, well, what is it that kind of can explain the spontaneous emergence? And in Boston, I think one of the things that was interesting is that Boston, if we go back to this ecosystem idea, Boston had what seemed like most of the critical components, right? It had a large venture capital industry, had a lot of important players in terms of innovation. It has many of the best universities in the United States. But the story in Saxenian, which was largely true in the early 90s, is a lot of this talent and intellectual property was locked up in a small number of large companies. And to some extent, it seems like the emergence of entrepreneurship in the area was tightly tied to the decline of some of these existing businesses. So this is Polaroid's headquarters, which are on the banks of the Charles River. Polaroid, as cameras became digital, quickly found itself irrelevant and laying off hundreds, if not thousands, of engineers. And many of those people then went off and either started or became early employees in other types of startups. And so, I think one thing that could be interesting in terms of, getting entrepreneurship going, although one that's not necessarily something that you would want to encourage a policy around, is sort of resource release, right? To the extent that, people are, employees in particular are tied up in these companies, what can oftentimes unleash kind of this initial surge of entrepreneurship, I think, is having one of these, kind of mass layoff or bankruptcy events that then leads to a number of startups. I mean, the same story seems to be true if we looked at, Waterloo in Canada. So when, Research in Motion is based in Waterloo, and when the BlackBerry essentially disappeared, I mean, it didn't completely disappear, but became, again, largely irrelevant after the emergence of smartphones, that then led to, first an initial generation, then a second generation of these local entrepreneurs who really started companies in a wide range of areas. And it's one of the more dynamic and interesting regions within Canada. Be interesting to see if, the same thing might happen in the areas where Nokia had large operations in Finland. And then there's another question of, well, what happens, or why do we, see this process reverse? This is a photo of downtown Detroit. And, I think the other thing that, people sort of forget about is, in the 1920s, Detroit was really the Silicon Valley of its time. It was where there were a ton of entrepreneurs. There was a lot of entrepreneurial finance around the innovation of the automobile, and it was incredibly innovative and an entrepreneurial place. And yet, all of that, kind of vitality disappeared over time. And I think that was really, the flip side of this process, right? As the big three became bigger and bigger and started really, capturing all of those resources, then there were just fewer and fewer entrepreneurs, not just in the automobile industry, but I think really to a certain extent in almost all industries. And that's, I think, a really interesting kind of open area for research, is trying to understand better, kind of how these cycles begin and end, and whether there are interventions that, could accelerate or decelerate those processes. So with that, we're 1 minute from the end, but I can take a last question, perhaps, if there's one.
So there were two questions in the Q&A from the first, kind of your first half of the
Sure.
talk. I'll just, one of them is about, do you think certain locations are better at encouraging people to basically start the business, or do they lure higher number of potential entrepreneurs? And the other question is about whether the exit barriers are lower for firms in clusters.
Yeah. So the first one, I do think there's some areas that are better for entrepreneurs. I mean, I've done some research on non-compete agreements and the fact that places that have weaker or non-enforcement of non-compete agreements seem to be better places for entrepreneurs, not only because the entrepreneurs can spin out, but also because it's easier for them to get employees from other places. I'm sure there's other types of things that, some of the research in biotech suggests that, being located near universities can be valuable. Being in a region where there's a density of venture capital, I think makes it easier, to enter, because it effectively lowers the bar for how good your business has to be to get financial capital. So I think there's lots of different types of things that can influence the degree to which, kind of one region versus another supports entrepreneurship or stimulates entrepreneurship. Do clusters lower the bar for exit? I mean, they probably do, in the sense that if you decide that you're not, that your business idea isn't going to make it, or you're not cut out to be an entrepreneur, there are more jobs available within the industry where you have, skills and experience, and so you're likely to get a better job coming out. So yes, I do think it probably lowers some of the exit costs. Whether or not that's enough to offset the lowered, likelihood of success for starting a venture in a kind of a dense region, it is hard to say, and probably an open question.
Great. With that, I think we'll wrap up for today. Thank you again, Olav, for sharing your insights for the discussion, and for all of you for joining us today. We will see you at our next seminar or session, so please stay tuned for the announcements. Thank you.
Thank you.